Hi, everybody. This is Peter Schiff. It is Friday, December 16th, 2011. Well, we had a pretty eventful week in the precious metals market. A lot of people who had been bullish on gold have turned bearish. In fact, it didn't take a lot for a lot of the more tepid bulls, or even some of the more bullish bulls, to quickly cut and run or turn skittish on the market. And I'm sure many people who were on the sidelines are now breathing a sigh of relief that they didn't get in, that they didn't fall victim of this big bubble, this big mania. Of course, that's the way a lot of the media has been describing it. And of course, gold is a bull market. Like any other bull market, it climbs a wall of worry. And whenever you have a decline, that's when the worry intensifies. That's when you shake out a lot of the weaker players, a lot of the over-leveraged people who are just in there for the momentum, that don't really understand what's going on, but are simply buying gold because it's going up. And if it stops going up, they want to sell because they're afraid the market's going to collapse. But if you actually look at a long-term chart of gold from the beginning of this bull market, look at a monthly chart, you can barely even notice the action this week. Now, of course, gold had pulled back. We hit a record high, I think, back in September. So for the past few months, gold was already correcting. I think gold is now off about $300 or so from its record high. That's about 17%. That's the same percentage the Dow is off its nominal record high. Yet people are not running for the hills claiming the Dow is going to collapse because it's 17% off its peak. In fact, on the year 2011, the price of gold is still up better than 10%. That's a lot better than the Dow, which I believe is up less than 3%. So this is not a catastrophic decline, yet basically from the media and what you're hearing from the pundits, you'd think that was it, that it was complete pandemonium in the metals market and everybody is losing a fortune. That is not the case. Is it possible that some of the people who might have come in pretty leveraged up? Certainly, I think the December month, you have an expiration of the December contracts, futures and options. I think it's a popular month. A lot of people might have been making some year-end bets bullish on precious metals. Some of those bets obviously have turned sour based on the recent technical action. I also think that a lot of fundamentally bullish events have happened in the last month that should have sent gold up. The fact that it didn't, I think, is a reason that we had some of the selling. But that doesn't negate the fact that we have had bullish news coming out in the precious metals market that justifies buying this dip. And that's all I think it is. In fact, if you look at the chart of the gold stock index, the HUI, it's been trading in a range back and forth for over a year, kind of between 500 on the low side and 600 on the high side. All we did recently in a matter of weeks is move from the high end of the trading range to the low end of the trading range. And of course, whenever we hit the low end of the trading range, that's when you get all the bearishness out there. That's when people are afraid that this is it, the bull market is over, or the bubble is burst, depending on your point of view, and people panic and sell. That's why you're at the low end of the range, because you have all this selling. Then all of a sudden you get to the high end of the range and you get a lot of people who are bullish and they're looking for a breakout. And when the breakout doesn't happen, maybe they get disappointed and they leave. But if you look at where this trading range is forming, it is a continuation pattern in a bull market. That's how I look at it. We are consolidating rather spectacular gains from the last several years. We're moving sideways in a trading range. Eventually, I believe that the tentacles would point to a big move up in the price of gold once we break out. I think a lot of the people who are now calling an end to the bull market or the bursting of a bubble are simply making the call based on the technicians. Oh, we violated some moving average, or we went below some support line. That is exactly what happens in a bull market to frighten people. These violent moves scare a lot of people out of the market. And then when we make new highs, a lot of that excess baggage has been shaken loose because it's no longer there. But I think that the fundamentals argue for much, much higher gold prices. Not only what's happening in Europe, but what is happening in the United States and what is going to happen in the United States when people begin to worry about U.S. sovereign debt not just sovereign debt in Europe. So if you understand the fundamentals, you look at this decline as a buying opportunity to increase your positions in both physical metals and mining stocks. I think people who are traders, who are trading gold as well as having long-term positions, these are the levels where you want to enter. You've got pessimism picked up. In fact, you've gone to an extreme level. I mean, it's hard to remember a period of time where so many people went from one side of the trade to the other so quickly. You've got a lot of people now who are very, very bearish the metals market. In fact, they're looking for much bigger declines, and so I think a lot of people are potentially getting short. Ultimately, I think they're going to be forced to cover those shorts at much higher prices. If you want to short gold at the high end of the range, if you want to short the gold stocks when the Huey is above 600, that's one thing. But if you want to short the low end of the range, that is very, very dangerous. Now, at some point, I believe that we're going to get through the higher end of the range and keep on going. Now, what I don't know is how many times we're going to go up and down. How long is this trading band going to continue? But the one thing I am confident about is that we will resolve this to the upside, that gold is still in a bull market. I think it's going much, much higher, not only because I think it's technically in a bull market, but because I think the fundamentals have never been better for gold. There have never been as many reasons to own it, yet you have more people than ever doubting it, despite the fact that they should be buying. Now, one of the reasons that a lot of people think there's no reason to buy gold is because they think there's no inflation. You know, maybe they're reading too many Paul Krugman columns, but the bottom line is they think there's no inflation. And in fact, the numbers we got out today showed that inflation for November, or the CPI, the government's report card on inflation, showed no change. But of course, you know, the government writing its own report card on inflation would be like children filling out their own report cards. We'd really be surprised if they came home with all A's if they were the ones that were grading themselves. But even if you go backwards, if you look at the 52-week trailing CPI, consumer prices, according to the government, are up 3.4% year over year. That's not a small number, right? That doesn't evidence no inflation, especially given the weakness in the underlying economy that we have a 3.4%. And of course, if the government admits that it's 3.4%, it's a lot higher than that. So we have a big inflation problem. Now, we don't have runaway inflation yet. We don't have hyperinflation. In fact, a lot of people are trying to discredit the things that I'm saying, particularly Paul Krugman, who called me out in his column and on his blog, is saying, hey, Peter Schiff is wrong, the Austrian school is wrong, because we haven't had hyperinflation. Well, we haven't had it yet. We've had inflation. We haven't had no inflation. According to Paul Krugman, prices should be falling, given how weak the economy is. They're not. They're going up because we have a lot of inflation. And I've never said we would have Zimbabwe-style, Weimar Republic-style hyperinflation for sure, or that it would happen by 2012. I did believe that the CPI would be moving at a higher rate than it is by now. Things have happened, I guess, beyond my control. Paul Krugman played some clips, or didn't play it. He transcribed something that I said on the Glenn Beck program, I think back in 2009. Glenn wasn't there. Charles Payne was a co-host, and we were talking inflation, and I was postulating that inflation would be a lot higher by 2011 or 2012, and I thought maybe the government would be dumb enough to put on price controls because of the inflation. Now, of course, 2011 is almost over, and we haven't seen that type of inflation. Although, remember, when Richard Nixon put on wage and price controls in the 1970s, it was because the CPI was at 4%. And that was using a far more honest CPI. So if we were still measuring inflation now the way we did back then, we would already be well ahead of the levels in which we foolishly put in wage and price controls back in the 70s. But I had expected inflation to be higher by now, at least the admission of inflation, the official figures in the CPI. Even though they understate inflation, I thought it would be powerful enough by now that the number would be north of 5%, maybe closer to 10%. The reason it has not, I believe, is because the problems in Europe have created a temporary demand for dollars as a safe haven. And so instead of the dollar being used, or all those extra dollars that the Fed has been creating, instead of those dollars being used to bid up the price of goods, instead they're being used to bid up the price of treasuries. They're not affecting consumer prices the way they will be ultimately when the world realizes that selling euros to buy dollars is like jumping out of the frying pan into the fire. You know, the people who are buying dollars are going to get burned. They just haven't figured that out yet. Maybe they haven't felt the heat, but it is there and they will burn. And ultimately, all those dollars are going to get sold. And when that happens, there will be much more downward pressure on the U.S. dollar. That will put a lot more upward pressure on prices, and you will see that reflected in the CPI. And maybe it will still happen by 2012. Though the interesting thing, though, about Paul Krugman is, I've been trying to get the guy on my show for years. I've been trying to have him debate me. Plenty of universities, including his own, have offered to host a debate between he and I, yet he always refuses. He likes to take a few jabs at me in his column, but why not step in the ring? Why not come on the Peter Schiff Show? I'll give you the whole 2 hours. You have plenty of time to talk. Why not hit at a target that can punch back, or that can move? He wants to take pot shots at a punching bag. Step in the ring and have a real battle with somebody who can move around and fight back. I mean, if you really believe in Keynesianism, if you think the Austrians are completely wrong and foolish, here's a chance to prove it. Take me down. Show me why I'm wrong. I'd be happy to discuss that crazy piece that you wrote about the babysitter co-op. I mean, if you haven't seen that, go on my YouTube channel and look at my critique of the model that he holds out as proving that money printing does not cause inflation, and somehow proving that the Keynesians are right and the Austrians are wrong. It doesn't prove it at all. In fact, it proves the reverse, which is exactly what would happen if Paul Krugman agreed to be on my show. And of course, if you don't want to come on my show, I'll come on any show you want. If you want somebody else to host it, if you want to do something live, hey, as I said, I'll meet you anytime, any place, and we can discuss. Doesn't even have to be a debate. It's just a discussion, right? We'll discuss economics. We'll discuss Keynesianism versus Austrian school, and we'll discuss what's going to happen to inflation and the value of the dollar and the price of gold. Anyway, remember, don't be fooled. Don't be, don't sell out your gold because someone on television scared you and thought this is it. The bottom's falling out. It's going to collapse. Again, I heard another pundit on television saying that, gold has no intrinsic value, and the minute it starts to fall, it's going to implode. No intrinsic value. It's the dollar that has no intrinsic value. Gold has intrinsic value. That's why it is money. That's why it's been money for so long. How somebody can see no value in gold, but all sorts of value in a little piece of paper? What value does the euro have? What value does the dollar have? What value does the yen have? It's just paper. Governments print it. They can print as much as they want. They can't print gold. It has to be mined. It's very expensive. First, you got to find it, and then you got to get it out of the ground. It's not easy. That's why there's not that much of it. And of course, gold has real intrinsic value. It has properties. It's a valuable metal with unique properties. It has all sorts of applications. Plus, people like it. I mean, if you give a woman a gold ring, she's going to be very happy. If you give her one made out of paper, I don't think you're going to get very far. So gold has real value. Dollars do not. It's amazing how so many smart people can't differentiate between the two. And speaking about smart people, if you're going to buy gold, and I recommend that you do, again, make sure, do not be fooled by any one of a number of high-profile metals companies who are advertising aggressively on the internet. In fact, if you're watching my YouTube video, there might be an ad for one of these companies right underneath it. But they're on television, they're on the radio. Don't let them fool you into buying numismatic coins. Anyone that bought some of these high markup coins a couple of months ago and they paid 60, 70% markup, now they're really down. Right? So go to my website, goldscams.com, and make sure and download my special report before you buy any gold. And again, also in that special report, I advocate not using leverage. See, the people that are on leverage, those are the people that are scared right now. Those are the people that, in some cases, are being forced to sell because they borrowed money to buy gold and silver, and now the price has gone down. They got a margin call. You don't want to turn what is really a relatively conservative investment, a way to store your value long term. You don't want to make it highly speculative by introducing the extra element of risk of leverage. Because if you have leverage, you might not have the staying power to ride out all the bumps. It is not a smooth ride, but it's a lot smoother than a lot of other assets. Gold has a lot less volatility than the stock market. Just look at a 10-year chart. You'll see a lot less volatility in gold than you do in stocks. Yet all the people on financial television who are telling everybody to buy stocks, oh no, don't buy gold, it's too volatile, it's too speculative. That's not what history shows. Anyway, that's it for today. Have a great weekend. I'll be blogging again soon. Take care, everybody.